episode of Investing Fool. We have completed 1 year of the portfolio. We started the portfolio back in mid of November 2023, and we started these videos in the month of December 2024. But it gives me immense pleasure to just have consistently completed 1 year of the portfolio. And a big thanks to all of you viewers and all those who have been associated with this channel and with our story from the beginning, or have joined us in the last few months. So that is one update. The scenario in terms of the market is not being very positive, so we'll discuss all that. It's also the rebalancing time, which is why uh, I'm putting out this video. The next video is also going to take a bit of a while because of my patchy availability during November. So things will get better by the end of November, and from December onwards I'll be putting videos more regularly again. But for today, let's discuss the market dynamics. Let's discuss the rebalancing, whatever is happening. There are many changes in the portfolio. For the first time, we are actually having to move to cash partially. So the portfolio is going to be around 22% in cash from now on, because we are not taking any new entries. So all of those things we will discuss in today's videos. So watch the video till the very end, and let's get started. Before we discuss any stocks or anything, the familiar disclaimer again that none of these are financial recommendations, so please consult your financial advisor before making any investments. All of these please consider just as educational discussion, illustration, or just knowledge sharing, right? So okay, so where are we in the mid of November? So market has been correcting for quite a bit. October was bad, November has been bad. The broader indices have lost quite a bit of ground, not massively, but still it's significant enough to cause pain to all kinds of long-term investors, whether you are a momentum investor, value investor, whatever kind of investor you are in the market. There has been some degree of pain that you have experienced in the last few weeks. So in terms of the monthly performance, we had a good run of 6 consecutive green months, which means we ended those months on a positive note. But October was the first red month after that run, and it looks like November will be the second consecutive month in red after October. So October, I think we lost around 7% or something. And yeah, in November we will see where we end up at the end of November. But for now we are trending in red in November. Nifty has been down around 10.5%, and when we look at our portfolio equity curve, which we plot by taking the portfolio values for every day, we have crossed the 200 DMA. So the portfolio equity curve is below its 200 DMA. Nifty 200 momentum 30 is below its 200 DMA. Nifty 500 is below its 200 DMA. So 200 DMA is generally considered as a signifier for a bearish phase of the market, not exactly a bear market or anything like that. So there is a typical tendency for the market, whenever it reaches the 200 DMA, there is a tendency for the market to go back up also, to resume some kind of run also, or in some cases it can just continue like going from like bad to worse, and to even worse. And sometimes it can just go sideways for a long enough time, which causes a lot of pain to someone like momentum investors because of a lot of whipsaws and a lot of churn. So as per our strategy, if you see here in the strategy tab on the portfolio, we actually do not take any fresh entries after yeah. So you can see here, run screener, exit any stocks that meet exit criteria, but no new entry. So whenever our core index, this actually I need to change, because we are not tracking the Nifty 500 like DMA. We are tracking the DMA of our equity curve, right? Which is a better representation of our portfolio compared to Nifty 500, because Nifty 500, the weights of the first 100 stocks, the first 50, the first 20 stocks is disproportionately large. Our portfolio doesn't have the same level of same representation, right? So a better gauge to make these decisions would be the equity curve of your own portfolio rather than the base index on which that portfolio is built. So if the equity curve of the portfolio is below the 200 DMA, then then we will only exit stocks whichever are meeting our regular exit criteria, right? If they are like out, if they've fallen out of the top 50 ranks in terms of momentum rankings, or they have fallen more than 25% from the all-time high on the day of rebalancing, then those stocks will be exited. However, there won't be any new stocks. So whenever we exit some stocks but we do not take new stocks in, then of course then the portfolio will move partly to cash. So that particular amount we will put in liquid case, and we will keep monitoring on the next day of rebalancing, then the next day of rebalancing, whenever we feel whenever we see that the equity curve has again gone has again crossed the 200 DMA curve, then again we will get in, we will take new positions. Till then there won't be any new entries. We will see how like this is done. Let's first discuss some of these metrics regarding exits and regarding the portfolio. So the portfolio has hit a new max drawdown of 13.6%. This might be again revised today, because today also the portfolio was down I guess around 0.500. Our base index was down around 0.3%, right? And today also, like I don't think the broader indices were any better. So Nifty 50 was down 0.3%, Nifty 200 was down 0.2%, Nifty 500 was down 0.29%. Curiously, Nifty next 50 or Nifty Junior was up 0.1%. In terms of sectors, some were green, some were red, so kind of a mixed bag. If we look at the portfolio, where's the portfolio? The advanced decline ratio was 1. So and some of the stocks have been removed. We'll talk about that, but broadly half of the stocks were green, half of the stocks were red, but mostly the bias was towards the negative side. And if we look at the price to earnings, this is a metric, right? And this if we take the clone PF, we'll discuss about the clone PF in a bit of a time, but this portfolio price to earnings based on the stocks that have remained in the portfolio as of now, that has come down to 71. That was at one point of time our portfolio PE was around 145. So you can see the kind of price action that we have seen in the recent past, because of which prices have collapsed so much that the price earning has become suppressed, and at the portfolio level the price earnings has come down from 145 to 71. And in the clone PF, like if we were to take I'll have to see whether this is correct or not. Q1 to Q13, I think this should be 17 here. If there is some issue, let me correct it very quickly. I guess this was around 95 or something. Let me check. Okay, it's 106 as of now, so definitely not as dire, but from 145 we have slid down to around 106, right? Still very high, but we do not use this to make entry or exit decisions or anything. It just gives us a gauge of the market, right? The kind of price action that is happening across sectors and stocks in the market. Okay, let's go back here. So the post-tax alpha is down to almost like 0.5%. We can see here, although on a pre-tax basis, the absolute return is around 27.93, around 28%, and our base index has returned around 24.4%. After tax and STT and charges, we are around 21.8%, and Nifty 500 based just on LTCG is around 21.4%. So we literally have lost all our post-tax alpha compared to the index. Whatever we had, and at one point it was around 7-8%. All of that has been erased because of the recent dynamics of the market. Okay. Portfolio equity curve, everything, like all these Nifty 200 momentum 30, which is one of the most representative large cap momentum indices by NSE, that has breached its 200 DMA. We can see the curve here. So you can see the Nifty 500 on the left hand side. This is the 200 DMA line. It has crossed below, like crossed its 200 DMA. The Nifty 200 momentum 30, this is the other index, it has also decisively like closed below its 200 DMA for the past like 3 sessions. So so in terms of momentum indices, we are definitely seeing the start of a bearish sentiment, and how long this can persist we do not know. There is a very high likelihood that markets take respite from some of this correction and may pull back from here. There is a high likelihood for that. But we'll just go as per our strategy, and you have to define your own strategy. Like some people just do not take any cash calls, right? They will continue to buy new stocks even if, like, regardless of whether the market closes below its 200 DMA or whatever, right? It doesn't matter to them. So you have to decide. There are pros and cons for both. For example, if we are in a COVID type of or crash, or a financial crisis, 2008 kind of crash, that was obviously like a slow kind of churn. But if we are in that kind of market, then like getting into a cash position temporarily may help. But if the market turns from here, right, the market turns from here, and and you're sitting in cash, then you would lose that recovery, because you are kind of exiting stocks at the bottom, right? And so you will lose the recovery when they go back up, right? Because you'll be sitting in cash, and 200 DMA is a lagging indicator, so it will take some time to reflect the realities of the market. If the market turns from here, 200 DMA will also take some time to adjust to that, right? So you will only make those changes or take new entries on your next rebalancing day. So some of the gains which could come in that interim period, you might lose on that. So pros and cons of both the things. As for me personally, I would not exit all the stocks when something goes when my equity curve goes below its 200 DMA. I will just not make fresh entries. So the stocks that are there which have not given an exit signal, those will continue to stay in the portfolio. The whatever exits I make, all that cash will go into a liquid case. Okay. So this time we are making 5 exits, 4 mid caps, 1 small cap, and as we discussed, no new entries this time. Portfolio has moved partially to cash. So if you can see here, I have created a new tab called Clone PF. So what is Clone PF? Clone PF I will just be using to measure the equity curve of the portfolio going forward, because the decisions I will take in the next rebalancing will be based on the Clone PF. So Clone PF, you can see these 5 stocks that are in yellow. These are new stocks, right? These are new stocks that have been added today. First of all, like the markets were closed on 15th, so we couldn't do the rebalancing as per 15th closing prices. Like even today also, we are doing the rebalancing based on the closing prices of 14th, which was the previous day. But if you see these 5 stocks that I just talked about, these are stocks that will be present in the Clone PF, and Clone PF will Clone portfolio will undergo regular rebalancing, just as we used to do for our normal portfolio. However, right, these are the stocks that I'm using just to compute the equity curve. So what is the equity curve? This is this thing, right? This graph that is there. Maybe it will take some time to load. Okay, here it is. So normalized, and you can see that like from like October, both have fallen quite a bit, right? Like from the mid of September, in fact, we had a pullback here, but then again we started correcting. So this is around second week of October, and we have been correcting ever since, and we have breached our DMA. So to compute this going forward, I'll be using the Clone PF. So whenever this line again crosses the 200 DMA, whenever the next rebalancing day after that comes, I will be taking the fresh entries as per the stocks that ranking at that point of time. So the Clone portfolio is just for the equity curve portfolio. In the actual portfolio, you can see there are only 16 stocks here. So we had 21 stocks earlier. We started with 20 stocks, and then because of one large exit, we increased the portfolio size to 21 stocks. And now 5 stocks have left, and there are no new entries, right? So we are left with only 16 stocks here, and these are like 4 vacant rows. And you can see on the 21st row, like where there would have been the 21st stock, we have liquid case here. So liquid case we have bought today with whatever cash we got from the exits of all the 5 stocks. What 5 stocks we exited, we will talk about them in a little while. Okay, in terms of the exit metrics, winner percentage and loser percentage have remained unchanged at 40.9 and 59.1%. So basically we lose money on 60% of the stocks that we enter, and we make money only on 40% of the stocks that we invest into. Then the average gain on winner has declined from 26.4 to 25.1%. Average loss on loser has also declined from minus 10.7% to minus 11.2%. All these metrics you can check out on the exits page. And for those of you who are watching our video for the first time, or have no context, so this sheet is like available, it is public all the time. So whatever we are buying, when we are buying, how much we are buying, whenever we are selling, why we are selling, all those things you can find on this sheet. It is always public, and the link is there in the description of all our videos, so you can check them out. And we have been tracking this portfolio of 20 momentum stocks from the Nifty 500 universe, and we just completed 1 year literally yesterday. So from now on we'll have to start publishing the CAGR as well. And it was a good year. We almost like we have 48%, maybe 49%, and then we have corrected so much, right? Things can change around very, very quickly, and we'll discuss a little bit about this as well. Average holding period has gone up significantly from 81.1 to 86.2 days. So almost close to 3 months. So every stock on average we are holding for 3 months, if you have to look at it that way. And why is that happening? That is because a lot of the exits that we made this time, you can see how many you can see this time held column, right? So Inox went 217 days, that is more than 7 months, right? Torrent Power also more than 7 months. Power India more than 6 months, right? Godfrey Philip like more than 2 months, and BASF 1 month, and in 1 month it gave us 28% negative return, which is very, very unpleasant. You don't want to have such returns, but that's the reality that you have to live with when you are doing systematic investing. You are not doing discretionary, so you have to follow a strategy. You know that the strategy works in the long term. You know that it may not work in the first 3 months, 5 months, 1 year, even up to 3 years, right? But in the long run it has a very, very high likelihood of outperforming the indices. So if you are coming with that bit of conviction, if you have your conviction based on data and not based on the returns that someone has shown, then you will stick to the strategy. This is actually a very, very good time to get into momentum investing, to start exploring momentum investing. And for those of us who have recently joined momentum investing, and I will put myself in that camp also, it's a very, very good learning opportunity, because it shows you that momentum is not a holy grail. It's not the answer to all your life's problems, right? It's not something that will just make money for you without any risk. Wherever there are returns, momentum being a high beta strategy is very, very risky. So you have to appreciate the risk. You have got some time to appreciate your risk, to relook at your sector allocation, and to see whether the strategy works for you or not, or whether you want to tweak something with it, right? If you are reasonably confident on the back-tested performance of the strategy you are following, and you are reasonably convinced about momentum as a factor, I personally feel it is the best factor out of all other factors, be it quality, be it size, be it value, be it low volatility. Momentum beats everyone hands down. Not always, not over all periods of time, of course, but in the long run it has a very, very high likelihood of outperforming all the other factors. So if you have that conviction, then you will stick to the strategy, and I will recommend you to stay invested, to stay the course. Markets can change very, very quickly. Okay. Market cap distribution over time has changed quite a bit. So you can see large caps are now like 50% of the portfolio, and the rest is distributed between mid and small caps. This we just covered. There were some other points that I wanted to share. First of all, I will change this to 106 because it's not 95. And total we have exited 9 stocks in November. So in the first part of November, which means just after October, the end of October rebalancing, we exited 4 stocks then, and we have exited 5 stocks like today, and 3 more stocks from the portfolio are very close to exit. So you can see Motherson at rank 48, Lupin at rank 46, Techno for at rank 45. All these are very close to getting exited. So we use the Momo India screener, which is a paid portal for rank. That's our strategy, that we will exit that stock. So these 3 stocks are very close to exiting, and if they do in the next rebalancing, we might move even more to cash, right? I don't know what cash level will go to till till the market turns around, right? In terms of sectors, pharma with 8 stocks, this includes 1 stock within healthcare, remains the largest sectoral allocation. And one more thing, if you look at the clone PF, right, if we would not have, if we would have taken new entries today, then the new stocks that would have come. So this is Deepak Fertilizers is in fertilizer space, Voltas is in consumer electronics, but you can see Fortis and Eris, both of these are related healthcare related stocks. So these defensives is where the market is kind of taking a safe space, because whenever like there is pain in the market, from the risk on sectors, money moves towards a little bit of the risk off sectors, but there is no hiding place that is always consistent. You can see what has happened with the FMCG index in recent times. Till then, on the rebalancing days, we'll be using the clone portfolio equity curve to compute whether the equity curve has crossed the 200 EMA or not. We are not actually buying those stocks. The only stocks that we remained invested in are the 16 stocks plus liquid case. Okay. Now, in terms of the overall picture, people can find all kinds of reasons that war is happening, something else is happening, but the primary thing that is kind of spooking the market is the strengthening dollar and the strengthening bond yields in the US market. Recently you would have seen that the Fed rate cut that was expected in December was not done. Even if the Fed would have done a 25 bips of rate cut, they were not sure whether it would make any material difference to the bond yields, because the bond market was not giving that signal. They're probably not agreeing with the kind of rate cuts that the Fed is making, and so the bond yields have remained high, and as bond yields have remained higher, and the dollar is strong, so money definitely will chase those higher yields, and they will get out of emerging economies. India was anyway on a pedestal. We had performed quite we had a really good run for quite some time, and that's why we have corrected so much, right? And the FPI outflow is just domestic money can keep can like balance against the FII outflow and all, and we are self-sufficient and Atmanirbhar and all that. The FPIs maybe have sold only 1 or 2% of their net investments in India right now, and we are here, right? Imagine if they go to 5 or 10%, where we would be. So it's a good time to take stock of the reality of where markets are, where like how much of sway FIIs actually hold over our market. So yeah, so that's is something that I wanted to mention. Gold is at a 2-month low, down almost 9%. I think in the last day it was up. I think today gold was up like 1.8% or something, but it was overall it is down in the last couple of months, and this is actually great. This is actually great news, because I'm anyway in the process of increasing my allocation from 20% to 25%. In terms of the overall asset allocation, you should also have gold as a reliable asset class, because as we have seen in the past, whenever the equity curve is kind of collapsing, gold typically has a tendency to rise. It doesn't have a it kind of shows a negative correlation in those scenarios with equity, or it is we can just say it is not correlated, right? Whenever things fall over here, then money runs towards a little bit of safety. And as in a interest rate, like in a declining interest rate environment, if it comes, whenever it comes, the rate cut has not happened for now, but that doesn't mean it won't happen in January, it won't happen in March or whatever. So whenever we go towards lower interest rates, typically gold is expected to perform better, and over the long run gold should do good. So I am personally adding more in my portfolio. Bitcoin has also hit a new all-time high. It's around 91k for now. So overall, from here, whenever that has happened, that Bitcoin has not done anything for a long time, and then it creates a new all-time high, things may be different this time, but then when it rises quite a lot, quite a bit. So that is something that you should have on your radar. And as I said, so much, they could like they could remain in a time correction for some months, maybe a year or more years also. I don't know, but the way I see it, there could be like some months of going up and down around this range only. And then if that happens, if that consolidation happens, that will be a very healthy sign for the market. And so it will basically, the markets will give time for the earnings to catch up a bit, because although we might talk about FII outflows and whatever, the reality is that earnings have not supported the kind of valuations that some of these companies were demanding in the market, right? So markets will probably wait a little bit for the earnings to catch up, and then again that will form the base for the next bull trend. So my personal feeling is that for some months we could be here, we could have some more pain, we could have a lot of whipsaws, right? And this could be a very painful period, but the downside from here, I feel, is limited. Like, I do not expect something like a 10% further fall from where we are currently. Anyway, the robust support that we have is around 21,800. So hope we do not go till there, and we hope we recover before that. Let's quickly take a look at the exits. So we made 5 exits this time. 3 of them are winners, 2 of them are losers. And in the winners also, we had gone so high, right? Inox Wind was at a total gain of around like 75% or something, and now we have to exit around 39%. That is something that we have to do, because if we do not exit now, like, this is as per our strategy, right? It has fallen below 25, more than 25% from the all-time high. If we do not exit now, I don't know, maybe this 39% will also evaporate, right? So Inox Wind has stayed for around 7 months, 39% returns. It has exited because of the all-time high level breach, 25% from the all-time high. Torrent Power has stayed for 7 months, did nothing basically. It went down, then again went up, then again went up, then came crashing down. We basically sold wherever we entered. 3.7% gains, marginal, no utility, just time waste. And it went out because of the worst rank held. It has not fallen 25% from the all-time high, but it is close, like 23% or something. Okay. Power India stayed for 200 days, 20.2% gain. Godfrey Philip, 77 days, minus 8.8%. All the FMCG stocks have corrected quite a bit. You can take a look at HUL and all other marquee stocks, marquee FMCG stocks. The fifth, this was a very painful exit. We caught the top exactly like here. Those who had entered around here, they had some respite. Okay, it is like maybe the good times are back. But then again, a market showed its true colors, and it had massive falls. Even today it was down 6%, and we have to exit with a 28% loss today. Just stayed like 1 month. This BASF chemical space just stayed for 1 month in the portfolio and gave minus 28% returns. So yeah, pretty painful, these kind of catching the tops. So these are the exits. Let's see if we miss something on the portfolio. Yeah, so we'll just continue remaining invested in liquid case till the time any new entries. Okay. Cool. I don't think there is anything else that I wanted to share. Excuse me. Yeah, I don't think there is anything else I wanted to share today. So thanks all for watching the video. And again, the next video, as I said earlier, could be a week away. So till then, take care, stay invested. Most importantly, do not leave the market. Stay invested. stay, like, follow your strategy to the T, and I'll see you in the next video. Till then, take care, and yeah, let's just hope that the market recovers a bit of ground before the next video. Take care. Bye bye.